Hello, today I'm going to be walking you through a gross margin analysis. Someone asked me how to conduct this analysis, and to be honest, I've never actually had to specifically look at gross margin, but this is sort of how I would tackle it if I had to. But if you have actual experience of analyzing gross margin in detail, please let me know on how you would tackle this differently. In our case, we are going to be analyzing the change in gross margin from quarter one to quarter two. And our company is going to be a retailer for tech products. So our revenue is primarily just going to be sales, and our cost of goods sold will just be how much we purchased the product for. So this is going to be a very simple example of a gross margin where we just have the sales price of revenue and cost of goods sold of purchase price. We have the source data of our financial transactions, which includes our revenue and cost of goods sold, and we also have the in-depth details of the products that we sold. Now, I thought this analysis would be easy, but I realized that it does get quite complicated depending on how detailed you want to get. For our case, we're just going to take it to two steps where we first analyze the change in gross margin and then determine which product categories are driving this. This is a template that I've set up for myself. However, feel free to create a template of your own if you'd like. Some additional details before we get started is that the company has a standard fiscal year. So January to March is quarter one, April to June is quarter two. And management has mentioned that prices have seen an increase in quarter two due to a company initiative, and that discounts may be provided to items here and there for promotions. Quite simple, and with these details, we can get started. So for stage one, the very first thing that I want to do is break down the gross profit by revenue and cost of goods sold so that I can determine whether it was higher revenue or lower cost of goods sold that drove the gross margin increase. And as I've mentioned, we have the transactions from our financial system and sales by product. Now, sales by product has more details, but the revenue and cost of goods sold information should match exactly what we have here. The reason why I provided you the case in this format is that when you are actually analyzing this in the workspace, you are most likely going to start from your financial data because this is what you're going to be presenting to the stakeholders. And when you need to analyze more in detail, you will then pull this detailed information from your company's internal database. So to start, let's first bring in the revenue for quarter one, where we are going to sum ifs the amount, where the category equals sales revenue. And we also need to make sure that the booking date is greater or equal to January 1st, 2025, and the booking date is less than or equal to March 31st, 2025. This is just to make sure that we are capturing the information for quarter one. And then for cost of goods sold, we are going to update our category from sales revenue to cost of goods sold. Let's copy this formula over, and then for quarter two, we're just going to update our dates where it is greater to or equal April 1st, 2025, and less than or equal to June 30th, 2025. And then same thing for cost of goods sold. Let's just update our category. And then for the gross profit, revenue minus cost of goods sold. And then gross margin is gross profit divided by revenue. And then for our variance, I am going to subtract quarter two minus quarter one. But for cost of goods sold, I'm going to do the opposite. And we can see that our gross margin increased by 6.33%. Now, to determine the impact of revenue and cost of goods sold on the gross margin increase, I'm going to divide the difference in revenue by the difference in gross profit. And I can see that revenue attributed about 76%, whereas cost of goods sold attributed about 23%. And we can also multiply this by our gross margin percentage just to see how much of the 6.33% is made up by revenue. And we can see that revenue makes up majority of the increase in gross margin, so our stage two analysis will focus on revenue only. Now in real work, you would want to analyze both revenue and cost of goods sold, but for this case, we are just going to focus on revenue, And I actually challenge you to take the skill sets that you learn from this case and continue to analyze cost of goods sold as well. But for now, let's proceed with our stage 2 analysis. Here, our goal is to break down the weighted impact of revenue on the gross margin by the different product categories to provide commentary on whether it's due to a price increase or whether we've actually sold more products that have a higher gross margin. So you'll notice that my analysis breaks it down by the price and the weighting percentage. The very first thing that we're going to do is bring in our total revenue by product category for quarter 1. So we're going to sum ifs the total sales by the product category. And this time we actually have a period field, so we're just going to use this rather than use a date. So this one is going to be quarter 1, and then product category is this. And we can see that the total revenue matches the total revenue that we reported above. So this information is correct. Next, we want to bring in volume sold. Our volume is in column I. So I'm going to update our sum range from column K to column I. And then for the average price, we're just going to divide revenue by volume sold. Now for weighting percentage, I'm going to divide the volume sold by the total amount sold. So this is how much these different products had an impact towards the final weighted price. And if I were to sum products, the price and the weighting percentage, it will get us the same answer towards dividing the total revenue and total volume sold. So I know that the weighted price that we have here is correct. Let's now do this for quarter 2. I'm just going to copy this formula over. Just make sure that it's working properly. And I'm just going to update the reference to quarter 2 volume. Now from here, I can see that the average price per product in quarter 2 is $9.96 higher than quarter 1. Now I need to determine whether this is because we sold more products with a higher average price or whether the average price per product increased. So I'm going to calculate the variance in price, and I'm going to calculate the variance in weighting. Now, just having this information here is not complete, but I can already see that the average price per product has improved from quarter 1. However, the mix for these high average price products have actually decreased. So there's some offsetting relationship here. So to get accurate results, I now want to break down the impact of price and weighting on this 9.96 increase in average price. And the way we're going to do this is how we normally tackle a variance analysis, where we quantify the impact of rate, which is our price, and the volume, which is our weighting percentage. So to determine the impact of the volume, I'm going to multiply the variance in weighting percentage by the previous average price. And to get the impact of the price, I'm going to multiply the difference in price by the weighting percentage. And if we sum this difference, it will get us to the 9.96. So we now have a breakdown of how much each product category impacted the increase in average price. Let's quantify this by dividing the attribution number by the total increase in average price. And based on these results, we can conclude that all 3 products had almost an equal impact towards the increase in average price. And lastly, let's divide the volume by the total attribution amount. And we can see that the main driver of the increase in average price was due to the increase in general price of each product category. However, the volume mix has actually decreased. And because we ended up selling less of the products that have a higher price, the average price decreased. But because the standard price of each product increased, we then notice positive impact to the average price. We can then multiply this weighting with the variance in revenue to quantify the dollar impact between the volume and price changes. So then the commentary that we can apply here is that all three product categories have seen a general improvement. And to finalize this, let's add a section for commentary. And what we can write here is that the gross margin increased 6.32% from Q1, mainly due to increase in revenue. This is mainly driven by an overall improvement in the average price of all three product categories. We are seeing a drop in product mix for the categories of higher average prices. However, the general price increase realized in Q2 has helped boost the average price per product from 176 to 186, signaling a 0 to calculated growth, which is about 5.6%, signaling a 5.6% increase. Overall, the company is performing well. However, we should keep an eye on the change in product mix to ensure the products with higher average sale prices aren't consumed by the TV equipment. Okay, and with this, the management now knows that the company is performing well, and the main driver of the gross margin is due to an improvement in revenue, mainly driven by the price increases that we've implemented in Q2. And with this, we have completed our margin analysis. Now, of course, from here, you can get into even more detail as we can break it down by product. However, sometimes having too much detail is not that good. I hope this video was able to give you insight to how to conduct a gross margin analysis, and I highly recommend for you to try this yourself as well. This file will be available on my website. If you have any questions, always feel free to reach out, and I'll see you next time.